Welcome back, all you tax-savvy real estate investors, and we have reached the final video on our series here in effective tax entity structuring for real estate professionals and investors. Now, if you followed along with us and watched most of the videos or all the videos in this series, we truly appreciate you. I hope you've gotten some education and some tools that you can take and use for your specific situation and reduce and optimize your taxes so that you can use that money to keep it and to help build your portfolio and accelerate your wealth. What I want to do here in this final video is just recap the 7 topics that we talked about quickly, and also talk a little bit about how you can deeper dive into these and some things to come in future videos and places to go if you want to look into more topics on these items. In the first video on the series, we talked about the legal versus the tax entity structuring side of things. And the main thing to take away from that video is to realize that there are potentially 2 separate structures to any entity, a legal and a tax structure to it. The other thing to take away from that video is we highly recommend that you're working with both a qualified accountant and a great attorney to ensure that you're getting this right, and also ensure that the 2 are collaborating on your entity structuring. Now, there's a ton more that you could dive into in the world of tax and legal entity structurings. There's holding companies, there's utilizing tax advantage states for things such as charging order protection entities, for anonymity, some things that you could get into with your attorney on that. We'll definitely dive into these in future videos. And I even want to bring on some of our good attorneys that we've worked with in the past that can help explain this a lot better and can actually provide the legal advice that you could use to effectively do so. The other things to take from this that we're going to get into definitely in some future videos is that you can get really creative in these structures. We kept it pretty basic in this series, and it's going to just get that much more complex and that much more interesting. So you can do all kinds of things with structuring the partnership and taking different profit and losses from it. You can utilize that C Corp to exclude capital gains if you do it effectively. So definitely some exciting stuff. That's called qualified small business exclusion, if you remember on that C Corp topic, section 1202, if you want to dive deeper now. But definitely get into those videos and make sure you watch them as we put them out, or go in on your own time and start to research some of these topics if it's things that could be specific to your situation and help you. Now, in our second video, we talked about active versus passive activities. And the takeaways here to recall is that your active businesses, those are the things that you sweat to earn, or that someone sweats to earn, right? Those are your W-2 wages. Those are the businesses that you're actively running. Your flips, your wholesaling, your coaching, whatever it is that you do in your day-to-day, that's what those activities are. Those are potentially retirement distributions from a traditional retirement account if you're in retirement at this point and taking those distributions. Now, for your passive activities, those are things that even if you're working within them, the government assumes that's your asset earning the money, right? So you took your money, you invested in an asset, and that asset is earning you money. If it's called rental income, it is probably a passive activity. Those also might be passive businesses that you invest into, right? So if you do a private equity investment or some type of passive investment there and it creates income for you, it gets you a K1, that could be a passive activity. But in general, it's income or losses which you did not actively work to earn dollar for dollar. The other thing I want you to take away from that video is just the goals of active versus passive activities, because each has a different goal. The goal of an active business is to make money. Let's get it straight. Like, earn money. I don't care if you pay 0 in taxes. If you're not earning money, it's not worth it. So make sure that business is running and that business is earning you money. And then use that money to either reinvest into that active business and make more money, or to pay down things that you need to pay or to fund your lifestyle, or use that money to invest into passive investments. The goal of the passive investment, that's to build you money in the future, right? That's for your future planning. So you use those passive investments for future earnings. If you go into it with the goal of using your passive investments early on to provide enough cash flow to fund your lifestyle or to allow you to reinvest into more passive investments, it is very risky. You're probably going to be disappointed. Down the road, you can get there. But to start off, you need that active income, because that passive income, it's going to take a while. It's going to be a slow burn, and it shouldn't be the goal of that passive income from the get-go. The goal of that passive income should be to build income down the road, and it should be to provide you tools that you can use to offset taxes by creating and accelerating and increasing those losses on the passive investments. Now, diving deeper here, what we're going to get into in some future videos, or if you wanted to take time to go into, would be just learning more about real estate professional status. You know, what activities qualify for that? If you're in a W-2, how you can potentially get out of that W-2 to earn it, if that makes sense for your situation. In future videos, we'll also likely dive into some things like how you can get into some of these passive investments, how you can create passive income if you're sitting out there with passive losses, time that up effectively, how you can use credits when it makes sense to do that, and some deeper topics such as that will really help you understand your active versus passive, break off a business entity structure to be a passive entity if it makes sense, and just do some really cool things to ensure that you're optimized from both an active income and a passive income or loss situation. In the next video, we dove into structuring your passive real estate activities, right? So we talked about utilizing LLCs and partnerships, and the big takeaway here is be very, very wary of putting any of those buy and holds into a C Corp or an S Corporation. Just if someone tells you about it, you hear a strategy to do it, get a second and a third opinion, right? There can be all kinds of tax consequences. We'll definitely dive into those deeper in future videos. So that's something to look into. Or if you really want to know what are the tax consequences or potential tax consequences if I do that, reach out, put it in the comments and we'll respond there. We then talked about structuring your active real estate ventures. And this is where the world of S corporations and even possibly C corporations came up for the right circumstances. The main takeaways you should get here are you're going to need an LLC or some entity in place. First of all, the LLC needs to be in place before you can convert to an S corporation. So first step, get the LLC in place. Next step, earn money. Next step, make sure you're in maximizing deductions, timing income and deductions to minimize the tax effects on that. And then get into the S Corp conversion when it makes sense, or possibly a C Corp conversion. Diving deeper, one of the most exciting topics that I think you might want to get into on this is the retroactive S Corp election. Again, that's not going to work in every circumstance, but if you remember, you have that 2 months and 15-day period to go back, right? But there's also a potential 3-year and 75-day period to go back. But certain rules need to be met to do that, and certain items need to be in effect to do that. So getting into that in a later video, I think will be really exciting and really useful for some investors here. We then did a video to talk about some quick tips to effectively reduce that active business income, those active real estate ventures. We talked about timing and maximizing deductions. We talked about timing and minimizing income. So we talked about using things like the auto deduction and the travel deduction and all that stuff we're going to dive way deeper into in future series. But on the income stuff, we also talked about utilizing effective strategies such as hiring your kids when the time is right, ensuring they're doing the work and what that takes, and utilizing Roth IRAs for them. All topics that we'll definitely dive deeper into in future videos, but if you want to go into them now, go ahead. Otherwise, be sure to catch those videos when you see them come out. We then talked about how to create, increase, and accelerate those passive investment losses. We talked a lot about depreciation and bonus depreciation and things there, but definitely a topic that we will get much, much deeper into as we go here. The one you might be most excited about on this is the cost segregation. So if that's something that you want to learn more about, put it in the comments, reach out, definitely catch those videos when they come out, or do your own research on it and just get very, very into that, because it is some exciting stuff. And when it makes sense, it can be used very effectively. In our next video, we talked about how to use those passive losses to offset your active income, how to merge the two, and how it can be a challenge to merge the two, and they want it to be a challenge, right? So that's the challenge where you definitely need to be working with a qualified accountant to ensure you're set up to do so. We talked a lot about meeting reps, so that's a big takeaway from there is if you can meet reps, do it. Documentation is going to be key. In a future video, we'll talk about that documentation. We'll give you templates to make sure you're tracking your real estate professional hours. And again, we'll talk about, we know a lot of people aren't doing this, but we tell clients all the time, like, you show up, you go under audit, be the golden child. Show up to that audit with our full real estate professional log, with our full mileage log. Like, you are going to be in the 1% of taxpayers, and the IRS auditor is going to love you. We would much prefer you're in that situation rather than in a situation where they're coming after you for this stuff and you don't have the documentation to prove it. So diving deeper into this topic, definitely reps is step one, but we talk all the time about the short-term rental loophole, and we'll talk more about that in a future series. Also passive income generators and using some other tools such as that. Restructuring businesses sometimes can get really interesting and allow you to move passive income to one side, passive losses to the other side, move active income or active losses to the other side. side. So it's definitely some really interesting stuff when you dive into it. So what are the next steps from here if you want to dive deeper? Well, definitely go back and re-watch any of these videos. If there was a piece that you didn't catch, you should be able. This is some pretty in-depth, pretty complex stuff. And we know not everyone is a tax accountant nerd. So definitely re-watch and get as much information from these as you can that you can bring to your qualified accountant and use for your situation. Also, comment, like, and subscribe to us here because again, we're just going to continue to provide more and more of this content. So if it's stuff that you found valuable, most likely you're going to find our next series and our future videos highly valuable as well. And they're going to contain items which you can put into use and use for your specific situation. Other things you can do is hop over to reitaxu.com and consider joining the community over there where we provide this content, but we provide educational courses and office hours, and there's a ton more valuable content over there and much more to come that you'll get over there that you can't get anywhere else. From there, go like us, follow us on our social media accounts. We're posting stuff there daily, templates and good content that you can keep using to accelerate your wealth through tax savings. But really what we want you to do from this point is just, if this is valuable content to you, keep watching, keep learning, keep growing, and most importantly, keep more of your own money in your pocket so that you can build your portfolio that much faster and accelerate your wealth building journey.